So we are on week 3 of our risk management lesson out of 4 on developing a risk management plan. So week 1, we went over setting risk parameters. Week 2, we went over tools for monitoring risk. And today we're going to be going over adjusting the plan in real time. It's going to be a short and concise lesson, so I won't take up too much of your time, but hopefully you'll leave here with some good reminders and actionable tools to improve your risk management as we move forward. So let's jump into it, guys. I have 3 points today. Point number 1 is going to be talking about adapting the risk management plan to market conditions, meaning current market conditions. Number 2, point 2, is going to be techniques for reassessing and adjusting risk parameters on the fly. And point number 3 is real life examples of risk adjustment. So it's going to be pretty brief. It's just some real life now billionaires who are examples of their ability to adjust their plan in real time. So let me open up the chat, make sure I didn't miss anything. Honest Money, glad to hear. I'm presuming that was about this weekend. So on point number 1, let's dive into it. Adapting the risk management plan to market conditions. So we need to understand market volatility as a whole, on a macro level as well as micro level. We need to be paying attention to the big things in life, like geopolitical events and any market conditions that may shift. We have to pay attention to the investor sentiment, and if we're bearish or bullish and on that end of things, and then also on the technical analysis of what's happening on the day-to-day real-time stuff. So I wanted to start off this lesson with a quote by Warren Buffett. No introduction needed. The market is the most efficient mechanism anywhere in the world for transferring wealth from impatient people to patient people. Pretty straightforward, and I think we can all, in our own way and experience, realize how true that is. So the markets are inherently unpredictable. We know this. If they were extremely predictable, there'd be a lot more people making money in it, then a lot of people wouldn't be making money, vice versa. So it's made to be unpredictable. We have to be aware of that as we're making our risk management plan and making our trades. So like I talked about earlier, conditions can change rapidly due to economic reports, geopolitical events, and shifts in investor sentiment. So that's on a macro level. We can really see what the start of a new war can do to what we're doing, a shift in the presidential race, whatever it might be. We need to pay attention to news on a macro level to see what's affecting our markets daily. And successful traders must be able to adjust their strategies in response to these changes to protect their capital. So, good real life example of that. If you know that there's some red folder news coming out today, some things that is really going to affect the market on a micro level, we need to be aware of that. First of all, first and foremost, we need to be paying attention. And then secondly, what do we do in response to that? We need to be able to adjust our plan in real time. So again, this is pretty short, it's a pretty concise lesson, maybe just be a reminder for a lot of you, but we need to be aware of what's happening on this macro micro level and then shift. So if there's increased volatility, we're probably going to take our position sizing and maybe half it or third it. And whatever that looks like for you, you may be going for 5% of your, you may be going from 5% of your liquidity per trade, maybe scale that back to 2 to 3% if you're seeing increased volatility. So that's just a real life example for you guys. So volatility indicators, I love to use the VIX. It's the fear index for the S&P 500. You guys have not used it, pull it up on TradingView. Super beneficial for a lot of different reasons. So tools like the VIX can help assess market sentiment. And increasing VIX, they signal the need to tighten risk parameters. So just like I was talking about, if you see the risk or the VIX start to spike, I'd probably recommend sizing down. Pretty straightforward. Um, or or setting tighter stop losses. And so my last little sub point on adapting the risk management plan to current market conditions is adjusting your position sizing. We briefly touched on it. So again, just to emphasize, during periods of increased volatility, consider reducing the size of your trades to limit exposure. So pretty straightforward, right? This technique allows for participation in the market while protecting against large losses. So I included that last sentence in there for a reason. I'll read it again for you guys. This technique allows for continued participation in the market while protecting against large losses. It's straightforward, but often it kind of gets minimized in this big thing we like to call day trading. So participation is a big thing. First and foremost, I think discipline is more important than almost any other skill set you can develop to advance your day trading career or your trading career in general. But participation in the market is important. If you're not participating, you're not making money. You're also not losing money. But when you see a really good setup that aligns with your risk management and your trading strategy, yet there's increased market volatility, or you don't like the price action, or there's some news that just came out. Well, if you are able to adjust your sizing and your stop losses on the fly and do it well, you'll still be able to participate in those really clean setups without, playing against this increased volatility and the increased risk that you're playing when news comes out. So I know it's straightforward, but a lot of us don't do this. We either completely sit out when there is news, and I'm not saying to trade the news on like news drops at 10 a.m. I'm trading at 10:01. No, I'm talking about throughout the day. Some people, when news comes out, they won't trade the entire day. I understand that, but if you still are able to trade within your risk parameters and within your trading strategy, all you have to do is size down your position or adjust your stop losses, and you can still participate and hit those goals of yours that you want to hit. So it's a reminder and maybe something new to some of us, because this is what I've been doing for some time, is teaching people on discipline and risk management and how to trade in general from the fundamentals. And I don't see a lot of people doing that. They're either completely sitting out, or they're trading too much and they're risking too much during these macroeconomic levels. It's something that I've noticed a lot, and it's something I've noticed in my own trading. So adjusting your plan, your risk parameters in real time is super beneficial. I need to learn this. That's me. I set out this morning. Good reminder. Yeah, absolutely. Hopefully these lessons, that's why I'm here. I know a lot of this sounds fundamental and basic, but these fundamentals are so important, and we see that. And you'll see at the end, my last point in point 3, these real life examples, these billionaire hedge fund owners who started out on the floor of Wall Street as normal traders. Their fundamentals are so on point that they can branch out and do more and more. It's just like professional athletes. When you look at the base of what they're doing, it's the fundamentals of the sport that they are excellent at, that they excel beyond most everybody, and they focus on that so much because they're so important. The same thing in day trading. Okay, moving on, friends. I will keep going over this. It's funny. So point number 2, techniques for reassessing and adjusting risk parameters on the fly. So let's talk about stop losses and risk to reward ratios. Like I mentioned, it's going to be a quick lesson today. All right, dynamic stop losses. As market conditions change, it's crucial to reassess and adjust stop loss levels. In volatile markets, tightening stop losses can help protect against sudden large moves against your position. So I don't know if all of you joined up for today's trading session with Jojo this morning. He did that when he held on. So he took profit about halfway down. I don't know, somewhere around 200 ticks. He was aiming for close to 500, I believe. And he held on to one runner. And then he waited for the formation of an order block or a 1 minute fair value gap, whatever it was. I can't remember exactly. But he adjusted that stop loss in real time to protect against that large move. And I remember I already had this lesson made up. I was like, dude, perfect. Jojo is an example of our dynamic stop losses and our risk management. He mentioned he's afraid that he's going to see a large move to the upside. And so he's going to move his stop loss down. And that's exactly what happened. So again, I know this stuff is fundamental. This is a reminder to most of us. Some of it is brand new, but don't be scared to adjust your plan. Just make sure that you're adjusting your plan according to your risk parameters. So I'm not saying just change your plan on the fly because your emotions get in the way and you're like, oh man, I'm making a lot of money right now, I'm going to scale in right here. No, I'm not saying that. What I'm saying is it is almost recommended that you guys have the ability at least to change your plan on the fly according to changing market conditions, because that's happening all the time in real time. So I won't beat the dead horse too much on this, but it is important. Like, these things are extremely important. As simple as they may sound, a lot of us aren't doing it. So I got another quote from Imperative. Thank you. That was the word I was fishing for. From Bruce Kovner. He's a billionaire hedge fund owner. You guys may have heard of him, or manager, excuse me. So here's a quote by him. Whenever I enter a position, I have a predetermined stop. That is the only way I can sleep. I know where I'm getting out before I get in. I'm going to repeat that last part. I know where I'm getting out before I get in. I sing that song every single day, folks. Is having your plan in place before you even enter the trade is so imperative. Thank you, Honest Money. It is of the utmost importance to know what you're doing before you jump into it. It's truly like, I don't know if you guys ever watch professional fighting, MMA or boxing or whatever it is. Every single one of those guys going into it has a plan. Though that plan may go to shit and everything hits the fan when they get punched square in the nose and they can't see as well anymore. But knowing your opponent and knowing what you're getting into beforehand is so crucial. Otherwise, it's like getting into a bar fight as a civilian with one of those guys. It's the same thing jumping into the stock market without a plan, not knowing where you're going to get out before you get in. It is going to hurt you much more than you may know because you don't know what you're getting into. So, practical example of this, your dynamic stop losses. If your original stop loss was set at 2% below your entry point, consider moving it to 1% if the market becomes more volatile than anticipated. So just like today, another example from this morning after market open, price action wasn't great. It's okay, that happens, but we still saw a setup. We still took it, but we adjusted accordingly. So if you jump into a trade and everything looks really good, price action is how you anticipated, your risk parameters are all going to according, and your technical analysis is on point. So you jump into the trade, nothing to worry about, and all of a sudden price action starts moving sideways. You get a bit of divergence in the markets between the Nasdaq and the S&P. Like, oh boy, like, geez, I should probably just cut it here. Well, instead, I would urge you to maybe just move your stop loss, or and sometimes it is warranted for you to get out right away, but oftentimes, just like today, Jojo was a little hesitant after he jumped into the trade because he saw the price action change. And we did see a little bit of divergence in the markets. That's okay, as long as your risk parameters are in place and you have this plan to be like, okay, I'm going to jump in. If PA is not exactly how I like it, I'm going to adjust my stop loss from here to here. And I'll still, even if I get hit there, won't be a big deal. And I'm going to move to break even as soon as possible. These little steps are, they're what is going to take you from a intermediate and semi-consistent trader. I don't even know if that's an appropriate word. An inconsistent trader, to be frank, to someone who can sit there and be extremely goal oriented and plan focused and execute based on their knowledge and experience in the market. And if you're able to do that, you will have no problem finding consistency in this market. All right, point number 2, our last point in techniques for reassessing and adjusting risk parameters on the fly, is reevaluating risk to reward ratios. All right, one moment, folks. I'm going to read the chat. What is up, man? How are we doing? To be the one that jumped in and out every day. So I'm learning a lot from Coach Joe and you, John. Thank you. Yeah, hopefully. I mean, Joe's, his confidence and the way he speaks now is so amazing to see, to where he was even a year ago. So when I jump on, it's pretty cool to see how he's able to teach and what type of trading he's doing now. It's super good. And yeah, even since April, that's cool. Like even you can see it. That's so cool. Yeah, that's awesome. Super happy. So reevaluating risk to reward ratios. So continuously monitoring the risk to reward ratio of your trades as conditions evolve. In more uncertain environments, it may be wise to enter trades with a higher expected reward relative to the risk. So I'll get into a practical example of that in a moment. In case I'm speaking too quickly, let me say that last part again. In more uncertain environments, it may be wise to only enter trades with a higher expected reward relative to the risk. Pardon me. So I have another quote from a billionaire hedge fund manager. I like those guys, at least what they are doing in the stock market. So Paul Jones says, if you have a losing position that is making you uncomfortable, the solution is very simple. Get out. So I'm not saying to jump out because you're feeling emotional about the trade, but if you feel uncomfortable based on your plan, on your technical analysis strategy, and on your risk parameters, if those rules that you have set in place for yourself are at the forefront of your mind and the trade is still making you feel uncomfortable, yeah, probably time to jump out of that trade. It's funny, these guys, again, focus on the fundamentals and they master them. And so here's a practical example of reevaluating your risk to reward ratios in real time. So if you usually aim for a 1 to 2 risk to reward ratio, consider seeking trades with a 1 to 3 risk to reward ratio in turbulent times to ensure that potential profits justify the increased risk. So just like we were talking about earlier, if there's macro news coming out that you believe may affect the market, or maybe it's just price action is a little ugly today, but there's no big news coming out, we'll shoot for some better trades. It's pretty straightforward. It sounds so simple, and it is. When you see that market conditions are not ideal, but you still want to participate in the market, let's do a couple things. Let's potentially tighten up our stop losses. Maybe not, though. Maybe we're just scaling down on our position size. We can do both or either. And then what I also recommend highly is seeking out higher reward versus your risk setups. So your risk to reward ratios really do matter, because seeking out those 1 to 3 trades and really sticking to those, if you're truly making 1 to 3 trades, your win to loss ratio could be terrible. You could be shooting for a 35% and you could still be profitable because you're shooting and you're actually taking profit at that 3 to 1 risk to reward ratio. So when market conditions aren't ideal, adjust your risk management plan in real time. It's okay to do that. Oftentimes we think of our risk management plan as so rigid that we cannot change it. I'm not saying that, though I do scream from the top of the mountains about keeping a risk management plan. That plan can be adjusted, and it should be adjusted even. So just pay attention to that. When the market is not ideal, let's make some changes and follow our risk management plan to a T, and we'll be okay. So we have one more quick point, and these are real life examples of risk adjustment. So George Soros, you guys probably heard of him, another billionaire trader. He These are just some real life examples for you guys if you want to look them up, see what they've done in their life. He was famous for his ability to, or is famous for his ability to adjust positions in real time. He famously bet against the British pound in 1992 when the market conditions signaled an opportunity. So I wrote down a key takeaway from George Soros. Flexibility and quick decision making can turn market volatility into an opportunity rather than a threat. So, like I said, adjusting those few things like your stop loss, your risk reward ratio, your position sizing, when we don't see ideal market conditions, can still allow you to participate and still allow you to be profitable as long as you are following these set rules. So it's pretty cool. And George Soros is famous for it. Now he's a billionaire. Pretty crazy. And then Stanley, I'm going to mispronounce this, Druckenmiller. He is also a billionaire hedge fund manager. Got a couple of those in here today. So his approach, he was known for his focus on macroeconomics, like we were talking about earlier, big time news, geopolitical events and whatnot. So his focus was on macroeconomic changes and ability to shift risk exposure quickly in response to new information. So what I always have when I'm trading is market news open. And so luckily we have JB. I know I say that like, oh, just pay attention to what JB's putting out. He's actually really on top of the news. It's incredible. I have not seen anyone else in related discords that is as up to date as a whole on news than JB is. So I do pay attention to him. But what I also do is I'll jump on like two different browsers. It'll be like Bing in Google or Bing in Microsoft or whatever it is. And I'll just have two of them open and I'll type in like market news or geopolitical events. And it may be different on either of them, but I'll refresh it like every 30 minutes. And because it takes me no time at all, it costs me nothing, but being up to date on that stuff is super important. And just like Mr. Stanley Druckenmiller, his ability to shift risk exposure quickly in response to that new information has put him in the position he's in currently. So pretty cool. Again, just some real life examples for you guys. If you guys want to look them up, I encourage you to do so. And a key takeaway I wrote down for him was consistently reassessing and adjusting your risk management plan in real time is crucial for long-term success in volatile markets. All right, folks, that's it for today. My last closing point I wrote down was stay flexible, trust your instincts, and remember, adapting to the market changes is how you turn challenges into opportunities. Keep pushing forward and success will follow. I don't know if you guys were paying attention to the chat today when JoJo was trading, but I talked about perseverance and how that is a revealing trait between success and failure in the market. And I believe that to be true wholeheartedly. Perseverance is such an admirable virtue. Perseverance is really what it's all about. I'm not just talking about day trading here, just in general. It's cool stuff, guys. Hopefully, I didn't bore you guys too much. Hopefully, you guys got a little reminder about what we should be doing for adjusting our risk management plan in real time. Maybe you learned something. Either way, hopefully you were able to gain some actionable insight today to go improve your trading. That's what I'm striving to do. Your feedback is welcome and appreciated. I am trying to do this to help you guys. So help me help you, or whatever they say. So Again, as you guys know, if you guys have been paying attention to my wellness classes as well, there's so much more at play to your trading abilities than just our technical analysis and our risk management plan. We need to stay healthy. Even if we do trade perfectly, we make our bank accounts bigger than we could ever imagine, none of that's going to matter. If we're sick and we can't move and our mobility is trash and our relationships are trash, I think you and I can both agree that if we don't have valuable relationships in our life and we don't have community and our health is gone to all hell, it doesn't really matter how big your bank account is. So focus on those other things first, and good things will follow. I can promise you that. So I appreciate you guys a ton. Like, I really do. I think people throw around the word love quite a bit, and I don't know how I feel about that. I see people saying they love this, that, and the other, talking about options and objects and whatever. But I truly love you guys. I appreciate you. I am glad you're a part of this community, and hopefully we are facilitating something special here, because that's what matters. So, alrighty, folks, appreciate you a ton. Go drink some water, go work out, go tell your loved ones that you love them, even if it was 10 minutes ago, 10 years ago. Those words matter. So have a wonderful day, and I will catch you tomorrow for my wellness class.